Hey everybody, this is Jose Blasco. We are about to get started. As always, let's have a quick sound check, a quick message on the chat box. We'll do quick hello, so I know you hear me and we are ready to get started. Please do that if you don't mind. We got 10 seconds to go. So again, quick sound confirmation with a quick message on the chat box. Thank you so much. Starting in just a moment. Very good. Yes, great. Perfect. Wonderful. Thank you for those confirmations, Mark. How are you? Hey, Joanne. Good to see you as well. Wonderful, wonderful. Perfect. Okay, let's get started, everybody. Welcome to the session. My name is Jose Blasco. Today is May-12, 2022. This is Options with Options. This is the live trading sessions that we run where we utilize our technology, look at the markets, and plan on trades, specifically to the options trades, looking at the markets from all angles, looking at different trading styles, especially with options, where so many different approaches, directional, non-directional, all those things could be done. So we love to spend some time putting those trades together and discussing it all. Okay. How are you, Christian? Good to see you. Before we get started, as always, we have a financial disclaimer that I am highlighting now on the upper left side of the screen. Please read it carefully. This is important information. Counting on you guys to read it completely, as it's fairly short, as I always say. Because again, as I just said, it's important information. Okay, so please take it seriously. Thank you so much. How are you, Jeff? Good to see you as well. Very nice. Cool. So the agenda for today, we're going to be looking at the market. There we'll look at the trades that we have running. We have some work to do there. You'll see some of them are concluded. Some of them need to be managed. So we'll talk about it. And then we'll talk about new possibilities, new trades, potentially assuming the market will give us those opportunities. Okay, so we'll be doing that. Okay, so also before we get started here, I wanted to highlight the questions page. Okay, so you could utilize the URL tradewithufos.com/Jose. That will bring you to this page that you see on your screen right now. And this is a page where there is a spreadsheet here that I have not started using, but I will, where we're going to be documenting and supporting the sessions that we do with additional contents for your review. And as you scroll down, you get to the question section where multiple questions are being posted, answers are being given. And for the ones of you attending this session for the first time, or if you're new to what we do, you can find plenty of answers there waiting for you already. If your question happens to be more specific or is not there, you can always click on the green button and post your question by clicking on Ask Question and just post it. Okay, you just need to be logged in to be able to do that. Okay, cool. By the way, you may see me use my computer a bit slow today. I'm happen to have a little bit of a technology problem with one of my monitors here, which I'm using for the session. Give me a second, guys, because give me a moment, if you don't mind. Just one sec. Yeah, hopefully this should be fine now. Okay, sorry about that. So anyway, yeah, so that's the questions page. And from there, we're now going to jump into the markets and begin our analysis. Okay, so the first thing, I guess we all know the market has been falling hard. This is not a news. So I'm going to come back to this and analyze this more specifically, more carefully. But because of that, obviously, I would like to start today with the VIX, which, as we know, the VIX has been going higher. So this is a 55 minute of the VIX. The VIX is currently trading around 33%. And again, not too long ago, it was trading at 20, 25. Next thing you know, it went all the way to 36, okay? And then it relaxed a bit and then again back to the 30 plus. So we took advantage of high volatility conditions in prior weeks to do some non-directional trades such as iron condors and so on. Again, the VIX that went down came back up. And again, we are back to 30 plus levels, which is pretty high levels of premiums across the board. Which again, why is that happening? Well, this is happening because the pretty violent movements that we saw in the markets are obviously triggering a lot of options trading, both because there are many people out there that are very scared and they are buying puts for protection like nonstop, but also others that are less concerned by risk and they don't want to miss on the moves. They are actually buying also many calls, expecting the market to rally very hard after such a drop. So all of this is increasing the prices of options, okay? And this is our opportunity to take advantage of high levels of premium in different scenarios. Taking advantage of high level of premium is often seen as doing non-directional trades, which for sure that's a valid way to do it. But also directional trades could be also could also indeed take advantage of high levels of premium, as we will discuss later when it's time to put trades in place. Okay. Now, so far, by knowing that the levels of premiums are high in the marketplace, let's look at the S&P as the index that represents the marketplace itself. And let's do a little bit of market analysis here to understand where we are at, what's likely going to happen, what do we do with our trades, how do we position ourselves, etc., etc. Okay, so let's take a look at that. But also I can see here a few comments and so on here. So Mark, some of us will be meeting after the session in the trader meeting space. That's fantastic to see. Joe, Jose, if you happen to roll a position, would you explain how to track in positions? Yes, certainly I can do that, Joe. And I believe, if I am not mistaken, that I read this question the other day, and you were suggested by the support team that I explained that. Am I correct with that? Because it's many questions, and sometimes I get confused or distracted. So confirm to me, please, Joe, if that's the case. Okay, and then I will use a bit of time to explain that properly. Okay. Yes, great. And I love to hear that. Okay, I love to hear that, Joanne, Mark, everyone, that you guys are getting organized and meeting in the room. That's fantastic. Okay, that's fantastic, because again, trading is all about community as well. Trading is all about managing emotions, therefore keeping you guys, each other accountable, etc., sharing experiences and so on. It's extremely valuable. So I love that you guys are now doing that. Okay, thank you for sharing. Yes, Joe, I hear you. Perfect. So I'll do the market analysis. I'll look at the positions first, and then I'll get to your question, Joe, with rolling and how to basically monitor all of this on the positions window. Anyway, so S&P. Let's take a look at what's happening. Okay. Well, first of all, if we zoom in here, okay, we are in a down climate, which is confirmed. Statistically speaking, this climate should last by 3 candles. It's been running for 5. So we are in a climate which is now reaching its statistical end. The prior week when we met, we were in a similar position. But remember, I was mentioning that if we were to have a little bit of a pause like that, and then back to red, okay, we could have climates that continue progressing aggressively to the downside, because the fact that the prior climate was more extended than what the statistics suggest, the fact that the prior climate stretched all the way to 2 or 2 point something, where the 2 standard deviation of the max distance was 1, was telling us that the energy pushing to the downside, it's certainly not a joke. And therefore, 2 things could happen, which is when it turns blue, it confirms as blue. Instead of a thin dot, you get a thick dot. And that is coming together with implied volatility of the calls in blue color above the implied volatility of the puts in gray color. And if that was to be the case, that would probably signify or represent a very high probability for a downturn and the market to go back higher. But guess what? When that dot was blue, it was a thin dot. And on top of that, as you can see, the implied volatility of the puts, which is gray color, was above the blue color implied volatility of the calls, meaning that there were plenty of sellers in the marketplace. And look at what just happened right after. Very violent move to the downside. If you were quick to act and you find some UFOs were available in multiple stocks, with that retracement on that particular day, when the market retraced a little bit and the climate was already confirmed to the downside, you could have got into very powerful shorts, and some of those trades paid very well. And, probably you already reached your targets and you're out. Again, that implied quick action. Okay, quick action, but perfect plan. We talked about it the other day, that when the climate is confirmed, and on top of that, the implied volatility of the puts being above the implied volatility of the calls, confirming that this climate is likely going to propagate. So all of this was giving you a clear measurement for what the environment was at that time. We call it climate. It was a clear, powerful climate, and it's evolved, it's propagated. Okay, now what's the issue now? Well, the issue now is that, like we've seen before, we reached a peak of 145, which is more than 1. So that is, technically speaking, too far, too fast, based on statistics. And one more time, 5 is more than 3, which is kind of like the same we saw the prior week, which is the duration of the climate has surpassed what a one standard deviation is, meaning a normal case. So we are not in a normal case anymore, nor based on duration, nor based on distance traveled. And all of these suggest a change of direction. Okay, now, change of direction may mean just a little bit of a pullback to have a tiny change of climate like it happened here and go back to red. Okay, that could be the case. So we gotta be very careful. In situations like that, I have no problems. You saw me do it, for example, with the trade with Verizon, when we had the same environment 1 week ago or 2 weeks ago, I don't remember now. We got into a trade with Verizon on this particular day. We can see it there here on the left, on that particular day. And Verizon went heavily against us and then started going back higher. Okay, and then a bit against us again. Okay, so no problem of being aggressive. And on that day, at that price, start thinking to be bullish, but only if you were to use option strategies that allow you to build a buffer that allows you to be wrong by a certain amount, like I did here by doing the trade. I believe it was price was more or less here, but I was selling puts down here. I think I was using the 47 strike. So I was allowing myself, this amount of space to be wrong. It went beyond that, by the way. But again, with the puts I was selling puts and buying puts. So I was limiting my risk while I was giving myself room for this to keep falling a bit more before it turns. Okay. Well, we are in the same situation now. Again, going back to the S&P, where the market went too far, too fast, too much duration. So again, more likely than not, the market will go higher. How far higher? That's the big question. We will need to wait for price to go a bit higher so our climate changes from red to blue, and then check the implied volatility of the calls and the put and see if we still got the gray line above the blue line, or the blue line now is above the gray line, and now we are set for a healthy environment where the market goes back higher. So far, we are in a scenario where going short now is too late to the party. Going long now could be okay if you are a bit in the aggressive side, like myself, but only by, based on my trading plan. Everybody can do whatever they choose, and they can be as aggressive as they want. But based on my plan, what I would be allowed to do is be aggressive and go long only if I created that buffer that allows me to be wrong by a certain amount. Okay, which the way I did it last time was selling put spreads below price and use that credit to buy calls above price and put myself in a positive delta position. But if the stock was to drop, I have this buffer that allows me to be wrong, which kind of offsets the fact that I'm not waiting for a climate change. Okay, even though I'm not doing it when it's crazy, I'm doing it when the climate already proven 145 is more than 1, 5 is more than 3. So I'm doing it when, statistically speaking, we should have that turning point. Okay, so this is one possibility for us to exploit today when later we get into trading, like we did a few weeks ago with the Verizon trade, which we're going to review and see what's happening in this trade. Obviously, this trade is not working too well because the market continued falling, but we're going to review it and see if we need to do something on it to improve its performance and limit the risk and so on. We'll talk about that in a moment. Going back to the market environment, because the market has been falling so much, again, going short, like we commented last week, it's too late to the party. We need to wait for some blue changing to red to start shorting. Okay, so if you did it this week, if anyone followed that instruction from the last week, please let me know on the chat box, okay? Because certainly there were trades to be taken on May 6th, okay? That was a very good day to take many trades to the short side. Many stocks gave good entries that day. So if you were watching it, hopefully you got into any trade and you profited from that, but not any longer, because 5 out of 3 is too much now, okay? So not any longer. So again, option number 1, be a bit more aggressive by getting long using the approach I just mentioned. Approach number 2, having the VIX being so high, it's a great time for us to do iron condors like we have done in prior weeks. Iron condors, which we're going to review in a moment, such as the one we did with McDonald's with what's closed for a profit already, or iron condors like the one we did with, what was the other stock that we used? I forgot now. Lulu, exactly. Lulu, which this one is a trade that we need to work on, because since a few days ago already, some management actions should have been taken, given the fact that the probability count has been moving lower, even price surpassed the bottom purple line. And even though everything has changed, so we should be working on readapting this trade, which I'm going to do it today. Probably some of you have been doing it already, since those rules have been explained in prior sessions. But just in case, I'm going to go over the rules. I'm going to explain it. I'm going to do it, and then I'm moving to hopefully having time to find new trades. Okay. Let me take a look at your comments here. Joanne, I have zones around the high from after the open and news yesterday. If we can get above that, I will be happy to log-wise first real UFO in majors for me. Get you. I need to study the climate better. Very good, very good. Yes, and again, the climate. Thanks for sharing that, Joanne. The climate, again, in my mind, is a very convenient tool because it just makes you very objective, right? So 5 is more than 3, and that's it. Okay, or going back to the S&P, 1.45 is more than 1, and that's it. It's black or white, is what it is. So it makes you very objective, and you know what to do. Obviously, for other styles of traders or traders that are more experienced, that have been trading for years without using tools such as AutoClimate, certainly you can just do a proper, trend analysis. You can use other techniques such as, divergences, maybe on some key indicators, things like that, to kind of understand and measure how stable and strong a movement is, or how tired a movement is, and likely going to reverse and change direction. So there are many ways on how to approach it. But again, I would say that most of you have been in the sessions for a while, and therefore my trading style, and I love math and stats and computerized algos and tools that make your life easier and make you objective and mechanical. And therefore, AutoClimate does it for me, and I guess it works for you too. But there are other ways on how to approach it, and what Joanne just said there is also very interesting, which is you are identifying some UFOs or some key price points, such as the prior day high or current day high, things like that. And when price prove itself by going above or beyond some of those other price points, this could be another way to think of confirmation. Okay, like when we talk about the AutoClimate and we talk about the dot is thin and now the dot goes thick, and therefore the climate is confirmed. So this is also one way to think of confirmation. So you make yourself mechanical, because how much price needs to move higher for you to call it, okay, change of climate, right? So again, looking at prior highs, prior lows, looking at key UFOs that are traded through or respected, all of those things give you clues on where the market is going, and therefore gives you triggering conditions for you to take a trade in a certain direction or not. So all of these and all of the above, it's valid within the context of a trading methodology. The key is to have rules around and act based on those rules with no procrastination after you have backtested those rules, so you know what to expect. Okay. So thanks for that. Very wise and very kind of you to share, Joan. So let's continue with our session today. So first, I would like to go ahead and, you know what, I'll start from the bottom, since the one from the bottom is a trade that is concluded, so it's easy and quick to confirm. So this is McDonald's. So we did a 1 week Iron Condor last week. If you recall, we placed an order to close it. I don't remember how many cents, but basically the idea was to make 37.5 cents per trade, and this trade was closed yesterday. You can see it's not in my account here anymore. The McDonald's trade is gone, and therefore this trade was closed for a profit. Okay. Now, what if you didn't close it? Well, if you didn't close it, it's not necessarily a bad thing. You're still within the purple area, which is the profit zone. Statistics suggest that before Friday expiration, which is tomorrow expiration, you should still be within the purple zone. So if you didn't close it and you leave it alone, again, statistics suggest you're going to be fine. If we look at the race graph, okay, we are indeed in the green area. If you didn't close it, you are currently making $32.5. Yesterday, I did manage to close it for a profit of 37.5, which was my minimum as discussed when we were planning the trade. So unless you have questions, I don't have anything to add to this trade. This trade just worked according to plan. It was one of those very, very easy ones. That's the beauty of doing a 1 week Iron Condor, that normally if everything goes well, it goes well very quickly. Okay, so in the end, this close was closed on Wednesday, and that is with the VIX rising big time, right? So if the VIX didn't rise the way it did, if the market didn't behave violently the way it did, maybe on Monday, maybe on Tuesday maximum, this trade would have been closed. Okay, so very efficient rate of time decay. That's beautiful. Problem with doing those 1 week iron condors is that when the market moves against you violently, then there is very little you can do to help the trade. Even if you butterfly it and things like that, it doesn't do too much, because the fact that the expiration date is so close makes that premium to evaporate, and therefore whatever you sell against what you had produces very little premium, and therefore doesn't really help. Okay, so the good thing is that if everything goes well, you're out of risk extremely quickly, is very efficient. If things don't go too well, you are very likely going to take your full loss or close to the full loss, which is fine if you are fine with a trade plan. But again, the case with Lulu, for example, which is a case that we need to discuss today, it's a totally different case because we're using May 27. So we have multiple extra expiration dates. And therefore, this trade, which by the way moved against us quite heavily, so this trade is a trade that allows us to massage and massage and massage because we have multiple additional expiration dates. And then you end up, even if the trade didn't work well in your favor, you end up with such a smaller loss compared to the original risk that you took, or maybe you even end up converting a failed trade into a profitable trade. Okay, this could also happen, less often, of course, but it could also happen. So with the 1 week iron condors, it's just not going to happen. Okay, so that's the disadvantage, and you need to know this, which I stated last week, but I wanted to rephrase it. So as we review the trade and the trade is now over, it's clear for everybody. Okay, so if you guys have been in this trade with McDonald's, I'd love to know more about it. If you have been in the trade, you closed it, you've been in the trade, you're still in the trade, any question about this trade, let me know. I will delete this from my positions panel in a moment, but just in case you have any question, I'll be happy to comment. Second trade I want to review, I'll keep Lulu for the last because it's the one that will give us the greatest amount of work. So the second trade I would like to review is Verizon. Okay, so when we look at Verizon, move to the daily time from here of Verizon. So if you recall, we looked at this particular pivot low, we plotted the speed bump, price was trading in the speed bump. Normally when price gets into a speed bump, we have a bounce. Of course, with the major move of the market to the downside, we didn't get such bounce, but we had UFOs lower, and we ended up selling puts there and using that credit to buy the calls, which created a positive delta position. If I look at the risk graph, and I know I'm speaking quite fast, okay, but because all of this was explained, hopefully that's okay. So if we look at this, okay, you can see how this trade still currently has a 52 delta. So if Verizon rallies, you're gonna start seeing profit quickly, okay, very quickly. And because we have short puts below, actually theta is slightly positive. So we are not losing money on time decay, okay, which is great. So we are just waiting for the move to happen. Of course, if the move happens to the downside, so this trade has a risk of $958 right there, which is what you can see here on the right side. Why? Because we got two contracts with the puts, as discussed before, where the difference between strikes is $5. 5 times 2 is 10. That's $1,000 minus the credit received, which is 42. It's giving you a net risk of 958. So of course, we don't desire for this market to go down. We are actually bullish with 52 deltas. We are indeed bullish. We want it to go higher, which of course, when it's not, it's a challenge. Okay, it's a trade that is working against you in the context of a portfolio where you run multiple trades. So now this stock has shown some signs of strength, which is not surprising. The market has been hammered, and that stock has not been hurt as bad as the market. Okay, the market today. So if we look at the S&P today, the S&P today is showing 0.04. Let's call it 0.7. Verizon today is showing a little bit of relative weakness. It's down by 0.30. So today it's showing a little bit of weakness, but overall, with such a crazy move down to the market, if you think about the move that took place on the market going down on the S&P, then the S&P is trading close to the low, where Verizon is much higher than where the low is. And that is, because that stock belongs to a strong sector. So if you recall, when we picked Verizon, we looked for a strong sector. So we are in a position which is not efficient at the moment with the stock having moved against us, but it's not the end of the world. The stock is part of the plan. We were building a buffer that allows us to be wrong because being wrong could happen. and now that stock is trying to fight it back to the upside. And if that is successful, if that fight to the upside succeeds, we are likely going to see a very powerful move to the upside. That UFO is probably gone, because this is going to change to an up climate, and therefore the UFO is going to be gone, and then there is nothing until 54. So we may see a magic super fast move to the upside, because that stock belongs to the strong sector. And when the strength of the sector kicks in, and those UFOs go away and new green UFOs come in, which is what would happen if the market pushes higher. So then next thing we're going to see a totally different picture. Okay, so we just need to be patient. Just like last week, it looked terrible, and then all that strength coming in, was very, very big relief. So we may get to go from relief to now profit in the second wave to the upside. Okay, of course, we need to wait for this to happen, because the next action here, let me bring the risk graph back. The next action here, we have two choices. Okay, so if you are very concerned about this, okay, if you're very, very concerned about this, which I wouldn't be yet, okay, and the reason why is because on the S&P the climate is 5 out of 3. So again, we are more likely going to see blue than red. So because of that, I'm not that concerned. Okay, now I do want to see how does the blue on the S&P look like. If the blue on the S&P look like confirmed dots on the climate and confirm on the derivative markets with implied volatility of the calls above the implied volatility of the puts, then I'm going to feel very confident about Verizon. Just keep grinding to the upside, more slowly or less slowly, or faster or less fast. But I will be confident that the stock will prove itself. Now, if we get the same type of confirmation on the climate, which is goes to blue but is not confirmed, and immediately goes to red, and then implied volatility for the puts is greater than implied volatility for the calls, then I'm going to be concerned, because I'm going to be thinking that the move to the downside on the S&P is actually a longer term move. So this is not something happening on the daily time frame anymore. Now it's something happening on the weekly time frame and above, like I discussed last week when I showed you the weekly time frame. So then I would be very concerned for Verizon, and then I would act on it in a more aggressive manner to try to mitigate the risk the most I can, or even get out. Okay, which is something that we'll probably discuss next week. So my action for today would be either, if I'm already concerned, okay, so I can go ahead and sell the 55 call. So what happens if I sell the 55 call? Well, if I sell the 55 call, let me add sell the 55 call on top of what I already have at the current price. Let's see how much that pays me. I would say not too much, but let's see how much. So that would pay me 14 cents. So what did I do by doing that? Well, I reduced my risk by $14. So instead of $958 of risk, now I have $944 of risk. So if you are desperate to reduce the risk, you can do it, but it's so tiny that to me it's not worth it to do. Plus, I just mentioned my view on the S&P. I'm waiting to see what's going to happen to the climate, so then I could conclude if we are dealing with a major move to the downside in a new bear market, overall, larger timeframes included, or we are dealing with just a scary move on the daily time frame, and then the world is back to normal, which I would not be surprised for this to be the case as well, with so many events happening at a fundamental level, with change of interest rates, a pretty heavy war happening in Europe, etc. So, fair enough for the market and the investors to get scared to then get back to normal. Fair enough. But if the climate doesn't prove itself, then wow, now we are going down probably heavily. And for sure, I would be now acting on this more aggressively. I don't want to have 52 deltas if I am bearish overall in my portfolio. Okay, so we'll talk about this next week, because that's when I will have this answer. So again, if you are concerned, one action you can take is get rid of the 55, sell the 55 call against, but you can see the impact is not that amazing. Okay, what else can you do if the market proves itself and starts going higher? Well, then you could start looking at the puts. Okay, and let me copy spread again. And what I'm going to do here now is I'm going to add two legs, in this case with puts, and I am going to pretend that I close those puts I have. So I have two, okay, and the one I sold is the 45, so I'm going to buy back the 45. Okay, by the 45, and the one I sold is the 40. So I'm gonna sell the 40. Here we go. So if I do that, what I'm emulating here, guys, okay, by adding those two lines with the midpoint, what I'm emulating is that I'm closing the puts I sold 2 weeks ago. I'm emulating closing those puts. So I'm left with the call only. So if I do that, okay, what's going to happen? What's going to happen is that I am left, okay, with a position that has a risk of $100 only. So the most you can lose is $100. Okay. So now, to me, doing that, it's kind of like a bit nonsense because yes, I'm removing a lot of the risk of the trade, but now I am left with a position that has very little delta, 15 only, and plenty of theta against me. And now, if the stock doesn't rally and very, very fast, now I'm kind of guaranteed I'm going to lose 100. So, if that's the case and the current P&L is 67.5, I'd rather go ahead and close the trade and that's it, right? So if you are very concerned, closing the trade, what could be one way and you just lost 67.5, not a big deal after everything that happened, not a big deal at all. So that's the beauty of creating a buffer that allows you to be wrong by a certain amount. You can see the power of these concepts, okay? But just closing the puts and keeping the call, really, it's a bit nonsense. It's going to be inefficient, okay? So I would just close the whole thing altogether and that's it. Now, a different story is, what if those puts are trading for less? Okay, so meaning, what if the stock goes higher? So if the stock goes higher, the puts are going to be less. So if instead of buying them back at 106, let's say I could buy them back for 50 cents, and instead of selling them back at 34, I could sell them back for, let's say, 18. Okay, I'm just making up those values, but you will see what I'm trying to do here. So now, next thing you know, so your risk now is no risk. Okay, well, yeah, $22. Okay, so your risk is now extremely, extremely tiny. Okay, and now you still own the call. Basically, you own the call for free. Okay, you basically own the call for free, and now you can sell a call against. Okay, and by the way, if I sell a call against, sell the 55 call, and again, if I do it now, if you recall, that call was paying 14 cents, right? So if the stock rallies, which allows me to close the puts at those much better prices, that also means that call is going to have a better price. So instead of 14 cents, maybe I can sell it for 30. Right? So if all of this is true, which I'm obviously making up those values, what happens now? Well, now you are in a net credit position. So worst case, you make $8. Right? So you cannot lose anymore. And now if the stock rallies, you're going to make a very nice profit. Okay. So that's my ultimate goal. My ultimate goal is wait for Verizon to rally. And I'm explaining all of this because this may happen Monday, Tuesday. We are not going to meet until later in the week. So if this happens, watch it, right? So you can close those puts to make the trade risk-free. And now you are left with a call, and then you can sell a call against. Okay, and then you can keep improving that. There are other choices available as well, but I just want to give you simple actions, simple instructions, if you wish, for things that you can do by yourself on your own if Verizon was to rally quite powerfully, later in the week, meaning tomorrow or beginning of the week next week. By the way, this particular action was available on that day, but you really need to be quick. So I would expect that the majority of you missed it probably. But on May 10, okay, the high was 49.44. Okay, the current value of Verizon is 47.68. It went all the way to 49 something, all the way to here. So when that stock rallied to that level, you could have performed such action, and then you would now be in a trade with no risk or way less risk. And again, things could be different. We didn't meet that day. Even if we met, again, realistically, it stayed up there for very little time. It opened, went higher, and from there, whole crash took place. So you probably missed it unless you are such a passionate trader, spending the whole 6 hours and a half of trading time in front of your computer. So you probably missed it. Okay, but I'm just giving you those instructions so you know what to do if Verizon rally. You know what to do if you are very concerned about Verizon and we'll talk about it next week when we have more confirmation from the S&P. Okay, so let me know if you have any question about the Verizon trade before I move into Lulu. I'll take a sip of water. I'll also see some comments on the chat box, which I'm going to read right now. Okay, Christian, historically, a normal retracement in case of a recession is 32% from all-time high in the SPY. Not a prediction, but just what can be observed going back to pre-recession in data. To be honest, Christian, if you do the same analysis that you are mentioning here, and you do that in the era when markets became electronic, meaning starting from the 90s, the number that is relevant really is 50%. So when the market crashes by 50%, that's when it changes from bear to bull. So this, you can see it when the pandemic in March 2020, we got a 50% drop. You can see it in 2008. So again, 50% is really when you have those very, very, very significant turning points. Before the 90s, when the markets were traded by human beings and everything was cooler, so yeah, 32% was more relevant. And if you carry the analysis for many more years, that 32% is still very relevant indeed. But the number that to me is much more relevant is that 50%. So again, if next week when we have our conversation, we look at the climate and everything is confirmed to be red again, and we look at the weekly time frame and everything is red there too, and we look at the monthly time frame, so again, I would be shooting for a target of 50% down from the high. Okay, that would be the target. I would, my conclusion would be we are in a bear cycle all the way. Okay, from low to high time frame, it's a bear cycle. Okay, too soon for me to say that, and therefore, so far, I'm still expecting the market to go back up, and when it becomes blue, and we got confirmation from the options data as well, ready to go long. Okay, but we will have that confirmation next week. Okay, so back to Lulu. Yes, I get you. It's worse or it's better. It depends, right? It's so if you're using 50 and you quote the stocks at 50% discount in those moves, then it's better. Of course, there have been retracements as well during the market cycles where maybe it's dropped by, let's say the market has been dropping, I believe it's around 15%, something like that so far from the highs. So if let's say the market now is going to rally up and go back higher, well, if you were waiting for the 50%, then you missed it, right? Now, what's the whole principle behind this? I am not simply looking at a drop of 32% or a drop of 50%. I am looking at the climate first. So by understanding the market environment, I now know if trying to catch a move at these levels makes sense, or if the market confirms itself as bearish into next week, with another going from blue to red on the climate, so then I will be looking for the 50% because I will be understanding that the markets overall are in a bearish cycle. So far, it's not the end of the world, a 15% drop in a market. Okay, especially with everything that is happening out there with simply because what happened to the dollar, only because the dollar got more expensive, that justifies the market falling, because the dollar is more expensive, so it takes less dollars to buy the same stocks because the dollars as a currency are more powerful. So that simply could explain the drop. So there is nothing to be scared, if you wish. So let's keep it cool. Now, a different story is now if the climate confirms itself again to go down, and now we can see that propagating in larger time frames. So then, yes, 50% would be certainly a relevant value. So again, hopefully I'm not scaring anyone. As traders, we should not care, isn't it? There is no reason to be scared. We can go long, we can go short, we can use options with puts, with calls, have positive deltas, negative deltas. It's all about adapting to the market, which, by the way, the market conditions, okay, have been tough this year, okay, been really, really tough. You need to be active on your portfolios by getting into long positions with positive deltas, but also hedging with negative deltas, and also direction and non-direction, and just keep rotating and playing with all those type of positions to create consistent results. If you were too loaded on positive delta, too loaded on negative delta, and so on, it's been painful. Why? Because the market it's just like I remember my comments, earlier in the year when we had this move. And look at this blue climate, like it's going to the moon, breaking all statistics. But look at what just happened before. Two climates that were breaking statistics to the downside, okay, with the red color, that one and that one. But now, also right after this blue, the red one also breaking statistics. So again, very challenging market conditions, which happens from time to time. And not only with the S&P, with whatever you trade, there will be times where statistics are there to be uh, proven wrong, right? And then as a trader, because we rely on stats, then we get slapped on the face, or we need to be very active, hedging positions and running multiple positions in the context of a diversified portfolio to be able to balance out and keep making profits consistently overall, even though some positions fell badly, right? So we need to learn to do that to be able to be okay. 18%. Thanks for that. Again, yeah, I was not fully sure of the value. But anyway, back to Lulu. Again, these are very rich conversations that we're having, guys, because basically, let's say you are new to trading, which I know some of you are quite experienced, but let's say you are new to trading and you're listening to this, really, you are gaining, if you listen carefully and you make notes and you review your notes, you are really gaining plenty of market experience in no time, okay? So these are very rich, very valuable conversations. At the same time, let's move into the trades, okay? Because we have limited time and we need to get there, okay? And it's all important. So, what's happening to Lulu? Well, let's go back to the day when we built the trade. That was May 4. So if I get my probability cone, and sorry, not the line. If I get the probability cone, how come I cannot drag it? Okay, let me do this. I guess I got too many things there on the screen, and it becomes difficult to click in the exactly right place. So I'm just gonna move this to May 4, which is the day when we took the trade. Okay, last Wednesday. So this was where it was. Okay, so what happened since then? Well, since then, okay, the market. Sorry, so the market. This was May 5. So on May 5, okay, if you think about it, so here's your purple line. Okay, the probability cone was still not crossing it. What happened on the next day with this very, very powerful move to the downside? Okay, so what happened on the next day? Sorry, guys. Here we go. Now, so what happened on the next day? Well, on the next day, the probability cone crossed the purple line. So on that day, we should have tweaked the trade on that day, not today. I'm way too late to do this tweak, okay? Even though I'm gonna do it so you see how it's done. Hopefully you guys were on top of this, okay? Because obviously when you do non-directional trades, you cannot afford to do nothing if the market behavior is not non-directional. That's a very powerful impulsive move. You cannot just look at it and hope for the best, okay? You need to act on it based on the rules. So the rules were the purple line crossed, the cone crossed the purple line. So let's act on it. The action would have implied to move the upper red line to a new location based on the new location of the probability cone on that date. And now what? Now you move down to your intraday time frames, starting with 55. Okay, and now we are looking for two UFOs above and two UFOs below. We got plenty of UFOs here, but again, let me go back. Wait a moment, give me a second here. So that was on 5-6. Okay, so 5-6. Let me use my training mode to go back to 5-6. Okay, so that was 5-6. I'm just gonna click somewhere in the middle of the day of 5-6. Okay, and now what you're doing is that you're looking for two UFOs or more above, minimum two. Okay, so here were your two UFOs. So there is a UFO here, which is lining up with the red line, which is beautiful. Okay, so now if I go back to the daily time frame, okay, and again, just to emulate we were on that day, go back to May 6. Okay, so now you would have taken the puts we got, which were the calls we got, which is the 405 and 400. Okay, 405 and 400, which are all the way up here. Those calls would be closed for a profit. and new calls would be sold at this price level above the new purple line. Okay, this is the action that should have been taken. By doing that, you would bring in a lot of new premium into the equation and therefore reduce the risk of the trade. And then what? Well, then look at the next day. Okay, the next day, this is where the probability cone was. So again, one more time, we crossed the purple line. Second day. So what would you do? Same story. You would get the red line, move it to the new location of the probability cone, and then go back on that day. That was 5-9, correct? Yes. On 5-9, go back to the intraday time frame. Again, I'm going to do the same thing. Look for 5-9 somewhere in the middle of the day, and look for 2 UFOs above, 2 UFOs or more. And again, we got 2 here. So this will be the location, which in this case is 345. So what would you do? Back to the daily time frame, back to May 9 to not to confuse too much. What would you do? Well, the 365 calls that you sold at this level would now be closed for a profit, and new calls located at 345 would be sold to collect more premium and therefore diminish the risk of the trade. And that tweaking, I totally missed it. Okay, I'm explaining it now, but you should have been doing that because we talked about this in prior sessions. Okay, so I'm just reviewing the actions that should have been taken. Please comment on the chat box if you guys did it, if you were comfortable to do it, if maybe you were not in the trade, but at least confirm to me that this is understood. Okay, guys? So what else? Now we're going to the next day. So what happens on the next day? Well, on the next day, the probability cone is still crossing the purple line. Okay, but now what happens? What happens is that the red line would be above where it is. Okay, the red line would be above where it is. Okay, so from that angle, wait a moment, because I got this line vertically drawn instead of horizontally. I'm not sure why. Okay. This is interesting. I guess I need to stretch it a little bit. Yes, that's what it is. Okay, so I'm going to do it like that. And now back to the daily time frame. Here we go. So this was my new purple line. So notice what's happening. The moment we got into that day, which is May 10, so now on the bottom part, the cone is crossing the bottom purple line. So you would need to work on the upper part of this trade. Okay, you will need to work on the upper part of this trade, but you cannot. Why? Because the red line, you had it here, and the new location for the red line would be higher, okay? Which is kind of like moving away. And if you move away from where you are, you're going to add risk, not remove risk. So we don't move away. Okay, we don't move away because that would add risk instead of remove risk. So we are not going to do that. Okay, now on the other hand, okay, the probability cone not only is crossing the below purple line, the probability cone is also crossing the above purple line. So then what you would want to do is you will want to look at where is the probability cone, okay, on the expiration day, which is here, which this would be the location of the new red line, and you would also want to adjust based on that. But again, just like the upper part, it would mean that you are moving away from the location of the prior red line. Well, on the bottom part, same story. You will be moving away from the location of the prior red line, and moving away means increasing risk, not reducing risk. So then that day you would have done nothing and just wait and just keep playing the fact that time decay is working in your favor and so on. Thank you for those confirmations, Christian, Mark. This is great to see. So now, moving to the next day, we have the same scenario. So the bottom purple line is being challenged one more time, and now the upper red line happens to be in a new location again, which is now closer, not further away, but closer. Okay, and this is happening on that day, which is May 11. So what would you do on May 11? 11. Okay, so let's pick May 11, somewhere here in the middle of May 11. Here we go. So what will you do? You will look for 2 UFOs, and notice that you have 1 UFO, 2 UFOs, and therefore your purple line will be in the same place. So you're still relying on the 345 calls. So even though you had a challenge of the lower purple line on May 11, nothing needed to be done. So far, you got 2 tweaks, no tweaks on that particular day. And now we are moving to today. Okay, on today, we got a challenge on the bottom purple line, but again, if you were to look at the upper red line, it would be further away from the last red line, and therefore you would be adding risk instead of removing risk. Therefore, it's to be ignored. Okay, so where should we be right now? You should be in the same place since May 9. So you did an action on May 6, you did an action on May 9, and so far nothing else. That reduced the risk of the trade, and I would envision that the P&L would not be the best, but you would be in an okay position. We got 10 minutes to go. So much I want to share with you guys, and we only got 10 minutes to go. So let me show you something. I'm gonna try to, instead of doing the tweak today, I'm gonna try to emulate how it would look like if I did it on 5.6 and 5.10. I'm gonna try to kill 2 birds on 1 stone. I'm gonna try to get as close as possible to the real P&L of the trade, but also I'm gonna show you how you can backtest some of those tweaking techniques if you are evolving or if you are working on evolving some options strategies that are quite advanced. I'm gonna show you how you can do that. Okay. So be ready, guys. I'm going to show you something that I have not shown so far in the session, and hopefully it will open your eyes to things that can be done. And then, Joe, I will answer your question, and then we'll go. Okay? So, May 6. What should you have done on May 6? Well, I already went through the new location for the red line, the new location for the purple line, and therefore the fact that you would be using the 365 calls. Okay, again, I'm having a problem with my monitor, guys. Not the best timing for that. Yeah, 365 calls. Okay, and therefore you would be rolling. Okay, so let's get Lulu. And what you would have done, compare spreads, copy the primary. On that May 6, what you would have done is you would have closed the calls. The May 27 calls would have been closed. Okay, and 2 more calls would have been added. So I'm adding 4 rows, all of it with calls, which is probably confusing, but bear with me. So the first thing I'm going to do is I'm going to close the 400 call I sold. I'm going to close it. So sell 400 call. Okay. And the 405 call, which I bought, I think I just did the opposite. So let me do 405 here and 400 here. Yeah, here we go. That's the correct action now. Okay. So I am buying back the 400 call, which I sold. Okay. Sorry, guys. Now, so I am buying back the 400 call. I am really making this complicated for myself. Sorry. Give me a moment so I can focus on this and not make a mistake. Yes. Yes, this is correct now. Okay. So I sold the 400 call. So I am buying it back. So I close it. I bought the 405 call. So I am selling it to close. So I close it. Okay. So I am getting rid of those 2 calls. And then on top of that, now I'm going to sell the 265 and I'm going to buy the 270. So that would be the action to be taken. Close the 400 calls and enter the 265, 270 calls. Okay? So that would be the action to be taken. Now, the question is, which prices you got that day? Okay? Well, this is where now I'm going to add option chain. For Lulu, we are dealing with May 27 expiration date. Okay? We are dealing with the strikes. 265, 270, 400 and 405, and we want to know the prices on May 6. So I'm just going to move to that, and here's the information I needed. And why there is no 265? Is it because there is no 265? Let's go back to today. Today there is 265, but I guess they just released it. That strike was not available on May 6. Okay. Yeah, on May 6 there was 260, 270, 270 and 275. Okay, so I should have done 270 and 275 to keep $5 of strike price increment. There was no 265, so I had to keep it a bit higher. Okay, here we go. So real market conditions. Okay, so 270, 275, 405, and 400. Okay, so what do we have? Well, on that day, there were no trades taken on the 405. That's why the last price shows as 0. Okay. Yeah. So that's a challenge. Okay, it's not super liquid. We got 45 contracts here. We justify this last price of 35, but nothing here, 0, and no volume here, 0, 0. Okay, interesting. I could understand no volume on the 400, and the 270s is relatively close to price. So interesting. I was not expecting that. You can see there were volume on the put, but not on the call. So very bearish there. Anyway, so what do you do in this case? Well, the most I can approximate myself is to find the midpoint. Okay, so let me grab a calculator here. So the midpoint between 0.19 and 113 would be 113 plus 0.19 divided by 2. That's 66 cents. That's for the 405. Okay, so for the 405, 0.66. By the way, we are using 275 and 270. For the 400, so the math now is going to be midpoint between 28 and 130. That's 0.79. So 0.79. For the 275 call, so 43 to 49.2. That's 46.1. And that was, sorry, give me a second. Yeah, 275. So 46.1. Right, and for 270, we're talking about 46.10 and 50.3. So 46.10 and 50.3 divided by 2, that is 48.2. So 48.2 goes here. If I click OK, the first tweak provided a new risk profile that is totally distorted because those prices are too theoretical. So this exercise is not really helping what I'm trying to do. Sell by let me see if I did it backwards. Sell by sell. Yeah, I don't fully. Yeah, it's probably I got plenty of distortion on those prices, and is giving this. Oh my God, my friends. Not sure what happened to me here, but I'm not sure why I'm using the 275 strike. The strike I should be using is the 300. 65, not the 200. Yeah, this is a crazy mistake I just made here with the selection of the strikes. Is not the 270, it's the 365 and 370. So I was $100 away from the right strikes. Sorry about that. Let me redo this very quickly, and you may have to watch the recording because this is already confusing by itself. If I made a mistake like that, which is very silly, obviously I'm not helping you to not to be confused. Thank you for being patient with me, so I can fix that. Okay, so 365, 370. Let's redo what I was doing, and now we're gonna get to see this much better. Okay, so we got for the 365, so we got 174 plus 3.5 divided by 2, that's 262. 262 for the 365. 262, yes. And for the 370, we are dealing with 143 plus 225, which divided by 2 is 184. So we can now add 184 here. And now we're going to have the right thing. Okay, so here we go. Perfect. That's what I wanted to show. So what's happening now, notice that the first week got the risk of the trade improved, going from 429 to 364. That was the first tweak that was done on May 6. Okay. Now the second tweak to be done on the next date, okay, on May 9, would have done the same thing, which I'm not going to do because we're already surpassing the time. But the second tweak would have done the same thing. Would have reduced the risk of the trade further, right? Which is what we are doing. We're trying to offset the problem that this stock is not behaving as non-directional as what we wanted. Okay, so that's what we're doing, and so far that's it. Okay, that's what we are. We are still in the process of reducing risk. Now, the last rule I'm going to tell you, which that condition was actually met today, okay, is when the price itself, not the cone, but the price itself trades beyond the purple line, which this happened today right at the open. The open of that stock took place on the other side of the purple line. So then our rule says that it's time to butterfly. Okay, and just to clarify it for the ones of you that are, spend less time with us in the sessions. So let me write it on the screen super quick. So butterflying means that we are dealing with a 405 call and a 400 call short. But the last week actually was 250. Not make this mistake again. 350 call, 345 call, and then we are short the 285 put and long the 280 put. So this will be the trade that we have at this moment in time after 2 tweaks. Okay, so using 365, 370, and then 345, 350. Okay, this will be the 2 tweaks. So once you are there and now you get price cross the purple line, not the cone, price itself. So now it's time to butterfly, which means that you would close those calls for a profit, and then you would resell calls lining up with the short strikes. So that would be the 290 call and the 285 call, creating an iron butterfly that will give the trade a second chance and reduce the risk in a major way. Okay, so this would be this would be the actions to be taken, which again I'm gonna not do now because the condition is not met, and also I didn't do the prior tweaks. So I'm just gonna document this for future sessions for us to be able to track. But these would have been the steps to be taken. Okay. Now before we conclude, I wanted to answer also Joe's question. Joe, when I edited the spreads as you did, the risk graph didn't look anything like the new position. If it didn't look like that, it's because, the risk should have been 100% sure. Okay, should have been, let me use a yellow color, for example, should have been like an iron condor. Okay, like this, that shape. The only difference is that the distance from here to here in the new condor is less than the blue one, which is the original condor, and the risk of the trade is less compared to the original Condor, where the depth inside the red zone is more. Okay, that is for sure what you would have got that day. Now, if you enter the wrong strikes, like I did myself here, where I was not using the right strikes, then of course the shape of the risk graph is going to be different. Okay, and that is probably a manual mistake that could have been made in your case, Joe. That would explain the shape of the graph being different. In any case, and for the future, I would suggest you take a screenshot and you can send it or post it on the question page so we can analyze it together and point at where was the issue. In my case, I myself made a mistake a moment ago. Okay, so this happens. Okay, it happens, and it's so easy that you make a mistake like that. Sometimes, if you are not too used to do it, you make a mistake because you get confused, which happened to everybody. And if you are too used to do it because you do it all the time, then you get overconfident, like it happened to me. And then next thing you know, you make a mistake. So again, looking at the shape of the risk graph is kind of like the confirmation that proves to you did it right or wrong. Okay. So if your risk graph is not looking like that, it's because you are using the wrong strikes. Okay. So again, next time, Joe, it'd be great if you could take a screenshot so we can look at it together. Now, your question, Joe, concerning rolling. Okay. Now, to be able to answer more specifically, I'd love it if you could give me a specific example. So, what is it that you're trying to roll? Because the process is the same, but just to make it a bit more like what you have. Like, are you trying to roll a cover call, for example? So you have stocks and you're short a call and you want to roll the call. What is it that you are trying to roll? Yes, Christian. Yes, indeed. The answer to your question is yes. Yes. And to be honest, the results, it doesn't matter because in the end, markets are very efficient. So when you are in a choppy market or you are dealing with earnings, implied volatility is more. So your probability cone is more. So yeah, your iron condors are wider. When the markets are quieter, your iron condors are less wide. And in the end, the results you tend to get throughout a collection of trades is the same. Okay. Now, if you only backtest 5 trades or 5 stocks, then of course you may get whatever results. But if you backtest enough samples across enough stocks, then it doesn't matter because markets are efficient and that excess in implied volatility offsets for the choppiness, if you wish. Very good. So let's say we are dealing with an iron condor. So I'm just going to pick the chain. Okay. And I'm just going to pretend you did an iron condor on, Apple. And you did an iron condor maybe someone in April, let's say April 12, you did an iron condor. The price of Apple at that day was 167.66. So let's enter a position where you own stock. Let's say you own 100 shares of Apple that you purchased at 167.66 on that date. And also on that date, you were looking at the expiration date, and let's say you looked at May 20 as a valid expiration date to do a cover call, and you sold a specific strike. Okay, so let me take a look at 1 second just to make this a bit more convenient for the demonstration. So I'll look at the chart of Apple. That was, I said, April 12. So April 12 is somewhere here. Okay, April 12 is here. And yeah, so really, okay, let's say you were looking at those highs, for example, just to make it simple. Let's say you're looking at the 180 strike. So let's say on that date, you looked at the 180 strike of Apple, and using that May 20 expiration date, you sold a call. Okay. Oh, so silly of me. Of course, I'm using a past date, so if I use a past date, I cannot do what I'm trying to do. I guess it's been a long day on my end. Anyway, so May 20, let's say you are selling the 180 call. I need to do this manually. and then the price you would have got that day, let's say the last price was 189. So let's say you did this trade and you collected 189. Okay, so this is the trade that you have, and I'm just gonna copy, so I can put that in the positions panel, which is your question. Okay, and let's say you have this Condor. Okay, this cover call. So you own shares of Apple, but you are also short a call. Of course, this call, went down, 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 down in value is only worth 2 cents. So certainly it would make a lot of sense to buy it back and sell a new one. Okay, and that's because Apple just kept going lower. But let's say that Apple didn't go lower, and you are like, you know what? I believe Apple is gonna continue going higher. Okay, thank you for that, Christian. Let's say that Apple was going to continue going higher, and you're like, you know what? I just changed my mind. I don't think 180 is a good target. I'm shooting for a target of, let's say, 200, and I want to roll the call to a longer expiration date. Okay, and next thing you know, now you're looking very long term, and you want to use using current date. Okay, using the current date today. Okay, today. Okay. Why am I not allowed to move to today? Give me a second, guys. Okay. Okay, I'm not sure why is that, but anyway, I'll do it manually. So today is May 12th. Oh, I know why. Because being in Asia, it's May 13th for me, and the calendar is only showing May 12th because we are using the data from the exchange, and therefore I cannot click, in my case, in today. In your case, I'm sure it works if you're in the US or anywhere that is not Asia, that is not beyond 12 a.m. Anyway, so let's say that you wanted to roll and you wanted to use, let's say, I'm just gonna on purpose pick a very long expiration date like January 20. It doesn't matter if it's that long or 1 month only. Okay, and now you wanted to sell a new 180. Okay, so the question is, how can you have that in the positions panel? How can you emulate and assess that particular condition? So the way I suggest to do it is to right click on your position and bring it to a risk graph. Kind of like bringing it to the risk graph is very convenient. You can do it otherwise, you can even do it manually, but bringing it to the risk graph is very convenient because you can use the compare functionality. So when you click compare and you copy the primary spread, now you have two of the cover calls in this case. So what you could do is you could edit the spread and do the same thing I was doing a moment ago, but in this case it's way simpler, which is to enter one more leg to negate what you had, which in this case is the 180 call. So you can make that midpoint, right? So if you sold the 180 call at 189 and now you buy it back at the current price, so you're basically closing the call. Okay, and now you would be left with the stock P&L. Okay, and then if on top of that you were to add another option leg, and in this case you were to sell the 180 call again, okay, using whatever other expiration date. In this case, I think I was using, was it January 20, 2023? So if you were to do that and you click OK, so now you will be left with a new position. Okay, you will be left with a new position, and you can go ahead and right click, copy this to the clipboard, and you can now bring it to your positions window, paste it there, and now you would see the results of this tweak real time, updating for you. Once the tweak is done, to be honest, in the positions panel, I like to maintain the positions. I like to, this is again just personal preference, but I prefer to assess my trades, my tweaks, my changes, my rolls, assess it with a risk graph because of the compare feature is very useful for that. And once the trade is completed, so then I like to put in here only what I'm left with, because here you got two lines with the May 20 180 call. Again, you could have it and it's updating real time. Okay, but to me it would be more convenient that once you have assessed that particular action, so now let's say you got filled at 490 minus 3. Okay, so 490 minus 3 plus 189. So you can go ahead and you can do the math for yourself, right? And so you got 189, but you missed on 3 because you closed it today. So you have a net credit of 186, okay, plus the 492. So it's like you sold the January 20, 2023 option is like you sold it for 678. So you can just input a fixed price of 678, and then you can just delete those two rows, click OK, and now you copy this, and that's what you put in your positions panel, and this is what you track, which has embedded the benefit of the prior call that provided a profit before you rolled it. Okay, so this is how what I will do to track the net P&L, which is the sum, the net effect of whatever amount of tweaks and rolls you have done during the life of the trade. You keep just pushing the P&L down the line. That's how I would do it. Okay, so assess the roll using the risk graph, do the basic math with the calculator to find out what is the net total credit you collected after the roll, and then input that manually to that current unit that you are left with. In this case, that is January 20, and that only that is what you put in the positions panel. So now the net P&L you see here is including the prior P&Ls from the prior options used before you roll them. Okay, so I believe that answers your question. I can see your responses there. Wonderful. Perfect, my friends. Well, thank you for staying with me for extra 16 minutes while I was going through this mini lesson, if you wish, on the use of the positions panel when rolling in order to make your life simple and basically have a net view of what's the real P&L of a trade that had multiple steps taken during its life. And thank you for the question, Joe. That was a great one. And everyone else, thank you for joining as well. And we'll see you again soon. I will see you on Sunday. We have a top session, isn't it? So I will see you then. Take care, my friends. Bye-bye.